love the channel and find it useful in becoming a happy retiree. Subscribe today. Carl, what's going on? How can I help?
Hi, how are you? Good morning.
Good morning, Carl. What's going on, man?
So I'm at this dilemma now, and I just need some guidance. 20 years ago, I actually invested. I had a very risky high risk profile. I invested in a lot of stocks, and I was just more of a risky type guy. Now that 20 years later, I'm in my low 50s. I'm like trying to say, how do I move? I invest some of the companies I was at, like Apple and Google, tremendous returns. Now I'm at the point where I'm like, okay, now I'd like to take some of these monies out, more in a growth type of vehicle, an income type of vehicle. But I just don't want this huge tax event, and I don't know.
Hey, Carl, hang on one sec. Carl, we got to go a quick break. Great question, important because you got to worry about taxes and future returns. One, we can control. Two, not so much. But hang on the line. I'm going to answer your question when we get back from break. Thanks for hanging on a minute. And you have a question that is, let me catch our listeners up to speed. Back when you were younger, back in your early investing days, you were a lot riskier and you had a bunch of individual companies, and some of them have become a pretty big part of your portfolio today because they've done really well. And now you're in your 50s and you're like, wait a minute, am I taking on too much risk? Do I sell some of these companies, but then I'm worried about my tax bill in order to do so? What are some of the companies? And just give me a little bit more context around your question, and I'll try to give you my best answer.
Yeah, so what some of the companies I mentioned before is like Apple and Google. But the thing is now I'm just trying to, as I'm getting older, I'm like saying, okay, I don't want to be as risky. So I want to put in other financial vehicles. I'm not trying to take the money out. I'm just trying to put in a different financial vehicle. But then I'm just hesitant to do anything because I just don't want this huge tax effect, make it a taxable event, when I'm really not doing anything with the money, and I don't know any way around that.
You're saying, look, basically I'm staying invested. I'm just going from, let's say, a stock that's done well to another ETF that's maybe more diversified, but I don't want to do it because one of my main hesitations is the 20% tax bill. Let me ask, so this is probably a really important time to talk about that for just a second. And we're always faced with that challenge. You buy something, whether it's a piece of property or it's a stock and it goes up and it's done well for you. And then you think, wait a minute, now I've got to sell it or I want to sell it. Now I get penalized to do so, or I get a tax on my gain, of course, capital gain. There's short-term capital gain and there is long-term capital gain. And long-term, I think, is actually a little more confusing for folks because there's multiple different rates on long-term capital gain. What tax bracket are you in? Just ordinary income, Carl? Because that matters. That matters.
Okay, so I'm actually, the actual percent I don't know. Our household income is a little over $250,000. So I'm not sure if that's the.
Okay, so let me. So if that is married, if you're married, let's say.
Yes. Yeah.
If you're probably just over, so up to about 200, and this is for 20, these are 2017 numbers. So when you get to about 233,000, you are at the very upper end of the 28% tax bracket. But so again, that means you pay 28% on interest. You pay 28% on short-term capital gains. You pay up to your ordinary income tax rate. But your long-term capital gain rate is lower than that. So your long-term capital gain rate is 15%, if that's the bracket that you're in. So it's important to understand what our tax bracket is for long-term capital gain. It's not quite as punitive or as bad as what we're used to seeing on our paycheck. So we pay a much higher percentage on our wages. The other thing that probably nabs you guys right now is that you're just over the additional capital gain taxes that came along with the Obamacare or the healthcare legislation several years ago. And there's an additional 3.8% tax on that investment income if married couples are making over $250,000. So your standard, and this is why it's a little bit confusing, is that capital gain tax rates can be super low. If you manage to be in the 15% tax bracket or the 10% tax bracket or lower, so effectively 15% or lower, Carl, your long-term capital gain rate is actually zero.
Okay.
It's zero. Now, that's not where you are, and it doesn't mean that you could sell $1 million worth of an appreciated stock and not pay taxes, because the gain itself will impact your tax bracket. So there's only so much room and so much runway you'll get with that zero rate, and that gets more complicated with your CPA. But from what I can tell, you're kind of right there in the 28% range. You're probably going to pay the 15%. And then from what you're telling me, you probably have the additional 3.8. So you're probably at around that 18 to 19% clip. So
Okay.
it's a significant tax, but it's significantly lower than your ordinary income tax rates that you're used to. So I think that's kind of the first thing to really understand when you're ready to make a sale, an appreciated stock, you've held it for a long time. The long-term capital gain rates are not as bad as most of the other tax rates we're used to. And I think that's an important distinction.
Okay.
The other thought here is that if you've had a bunch of good stocks over the years, I'm sure you've had a few that have not done so well. Have you already taken some of those losing positions and sold them and taken a loss that could potentially offset some of these gains?
I have sold most of them. Probably, yeah, most if not all of them I have sold.
So you don't really have anything else trading at a loss?
Not at this point.
Okay, and this is all money that's not inside an IRA, correct? This is all after-tax money.
Correct.
Well, so again, it's unavoidable to some extent unless you have something else to offset it. If you have other losses, that's usually that's one of the main answers to this question is if you have any sort of other assets in another realm that you're in a losing position, you can offset some of these long-term capital gains. The other question is that do you really have are you far over allocated? Are you highly and disproportionately allocated to these companies or not? So are we talking 50% of what you have? Or are we talking 10 or 15%?
So in these particular funds, it's probably around 15 to 20%. 15 to 20%.
Okay. I would tell you that I know that. So the general rule of thumb planning, we'll say that about 10% is about as high as you want to be, right? You've probably heard that. No more than 10% in any one given stock. But there's some room in that rule. Again, rules of thumb are just that. They're meant to be a guidepost. So if you're 10 or 15% in a particular company, or even a little bit higher than that, and it's a super high quality company, there are companies that even though I might have my percentage might start to get to push up on that, I'm still okay with going a little past the 10%, because my time horizon on good companies, remember, it could be forever. I want my time horizon, Carl, to be forever. So just because you're bumping up against some of those percentages, if the companies you own are still really high quality and they're still doing what they're supposed to be doing and they're still pushing forward, then again, to me, I'm okay with holding that kind of company. What you could do, and if you're still a ways out from retirement, a lot of retirees, I'll say, look, wait till you're in a lower bracket. And that's why I brought up these tax rates. I'll say, okay, next year you're going to drop from the 25% bracket down to the 15 because you're in retirement. Then at that point, you have a potentially zero tax rate, and then you can make some of these adjustments for no tax. So, that's another thing to think about, is that very often when we get to retirement, our income goes way down, our tax bracket goes way down, and then our capital gain rate, the tax we have to pay on our capital gains, that can go from 15, in your case, closer to 19 because of this additional surcharge, can go all the way down to zero. So think about that. Don't get too nervous if you're 10 or 15%. in a couple of really good companies because they've done well. If they're great companies, doesn't necessarily mean you don't continue to hold them. But I think that there's a lot we talked about today for you to consider when it comes to diversification and taxes.
Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.